Listen carefully because what you're seeing right now is not just another headline about a ceasefire. While the world was distracted this morning, three structural signals hit the silver market at the exact same time, and not a single mainstream financial outlet has connected them. Shanghai just halted silver futures trading. COMEX short positions collapsed to their lowest level since early 2025, and silver spiked to $83.17 before the session was even halfway done. Three independent signals, three different data sources, all pointing in the same direction, simultaneously. That kind of convergence does not happen by accident. Today is Friday, April 17, 2026, and I'm going to be direct with you from the first sentence. This is not a routine market update. What you're about to see is the alignment of data, technicals, institutional behavior, geopolitics, and supply chains all compressing into a single moment. Not in 2011, not in 2025. This has never happened like this before, and if you don't understand what this means for where silver goes next, you need to pay attention right now. Each of these signals on its own would already be a major development, but that's not what's happening here. What I'm about to show you is that they are not isolated. They are converging right now. And the silver market has already started pricing in that convergence before most people even realize what they're looking at. By the time this video ends, you're going to understand something that the majority of investors, yes, even experienced precious metals investors, still haven't connected. There is a specific chemical supply chain mechanism responsible for roughly 75% of global silver production, and it is being disrupted at the source. The market has not priced this in yet, and when it does, this will not be a slow adjustment. If you are holding physical silver today, you need to understand this. You are not just riding a price move. You are standing at the intersection of three independently confirmed structural signals happening at the same time. And that matters. Because when technical positioning, institutional behavior, and supply chain mechanics all point in the same direction simultaneously, you're no longer dealing with sentiment. You're dealing with structure. And market structure does not reverse because of a headline. So if you're still on the sidelines, waiting for a better entry, clearer confirmation, or a safer moment today, I'm going to give you one piece of information that will change how you calculate that decision. Listen closely, because what I'm about to show you is not being discussed publicly, but it is already being built behind the scenes. The US and Mexico are actively constructing a price floor mechanism for silver, not announced, but documented. And once that floor is in place, the downside risk you're waiting for gets structurally limited. Today, silver isn't just moving, it's behaving abnormally. A 5+ intraday range, a breakout above $80 that held on the retest. That's not noise. That's a market under structural pressure, searching for its real price in real time. Gold is rising alongside it. Both metals are climbing on the same day, despite a ceasefire backdrop that should suppress safe haven demand. That tells you this isn't about fear. This is structural demand with nowhere else to go. Before the conflict, silver traded above $96. The drop wasn't structural, it was emotional. And now, the same fundamentals that drove silver toward $120 in early 2026 are still intact. Supply deficits, industrial demand, inventory compression, nothing broke. The trend didn't reverse, it paused, and now it's resuming with stronger positioning, tighter supply, and a system that's already under strain. Listen carefully, because this is where the signal turns into structure. The Shanghai Futures Exchange just halted silver trading indefinitely. No timeline, no resolution. That doesn't happen in a normal market. Emergency halts only happen when price pressure breaks the system. When physical demand overwhelms paper supply, to the point where trading itself becomes unstable. That halt is an admission. The balance in silver is already broken. Now look at inventory. China holds roughly 23.3 million ounces. Sounds large until you understand the context. This is the largest industrial silver consumer on Earth. Solar, EVs, electronics, semiconductors. At that burn rate, 23.3 million ounces isn't a reserve. It's a countdown. Signal 2 comes from the Commodity Futures Trading Commission. Bank short positions have collapsed to around 23,000 contracts, the lowest since early 2025, right before silver ran to $120. The entities that used to cap price are losing control. And now the third signal, almost ignored. China is banning sulfuric acid exports through 2026. That matters because 75% of silver is a byproduct of copper mining. No acid, no copper processing, no copper, no silver supply. This isn't volatility. This is supply being removed at the source while demand keeps rising. Now step back and look at the sequence, because this is where the structure tightens. Before the ban was even announced, Chile, one of the world's largest copper producers, reported its lowest output in 9 years. Supply was already tightening. And now, the key chemical input for copper processing is being cut off at the largest source globally. This is not speculation. This is a recorded supply chain decision taking effect next month. And here's the part most investors miss. Supply shocks like this don't hit price immediately. They take weeks, sometimes months. But when they do, the market has to absorb a metal already in its 6th consecutive year of structural deficit. Since 2021, over 760 million ounces have been pulled from above-ground inventories. That's nearly a full year of global production gone. Now layer on geopolitical reality. While headlines talk about a ceasefire, enforcement is still active. Blockades remain. Industrial supply chains are breaking. Aluminum cuts, export restrictions, energy controls spreading across continents. This is the environment silver is being priced in. Add stagflation, confirmed by John Williams, slowing growth. Rising inflation, a weakening dollar, and falling real yields. And suddenly, holding physical assets isn't optional. It's structural. Silver doesn't pay yield. But in a world of negative real rates, that's not a weakness, it's an advantage. Because the alternative, holding debt that loses purchasing power, is worse. Right now, the system is cornered. Cut rates and accept inflation, or hold rates and risk recession. Both paths lead to the same outcome: stronger demand for silver. But here's the part almost no one is talking about. The US and Mexico are quietly building a price floor for silver, a government-backed mechanism designed to support critical minerals supply chains. Think about that. If a floor is established, downside risk doesn't disappear, but it becomes structurally limited. That changes everything. You're no longer holding a commodity with unlimited downside. You're holding an asset supported at the institutional level by the world's largest economy and one of the largest silver producers. And the market hasn't priced that in yet. Meanwhile, top analysts are aligning targets from $100 to $170 by major banks, and far higher from independent models. Technically, silver is approaching the $95 to $100 breakout zone. Break that, and the path to $115, $120 opens fast. This isn't speculation. This is a structural revaluation still early. Let's be clear, $150 is not the ceiling. It's just a waypoint. Even in the most conservative scenario, a formal peace deal, oil collapsing, short-term deflation fears, silver could pull back to $65 to $70 and stabilize. That's the simple case. But here's what that scenario cannot reverse. The sulfuric acid export ban remains. Structural deficits continue expanding. Inventories don't rebuild overnight. Chile's copper output doesn't recover in a quarter. The trajectory doesn't break. It pauses. Now, yes, risks exist. A sudden dollar surge, exchange-level interventions like what we just saw at the Shanghai Futures Exchange, or a deep global recession could pressure prices short-term. But none of those change the core mechanism. Silver supply is chemically constrained. No sulfuric acid, no copper processing, no copper, no byproduct silver. That doesn't respond to headlines. It responds to infrastructure, and that takes years to rebuild. So if you're holding physical silver, understand this. You are positioned at the intersection of 3 confirmed structural signals: Shanghai disruption, collapsing bank shorts, and the emerging US-Mexico price floor framework. Volatility? That's noise. Structure? That's the signal. And the market hasn't fully priced it in. Yet, when this enters the mainstream narrative, the repricing from this single factor alone will be significant. Right now, that opportunity exists before it's fully understood. At $4,856 gold and $81 silver, low-cost, growing mining companies are generating free cash flow faster than their stock prices reflect. The gap between spot prices and junior miner valuations, especially after the war-driven sell-off, is one of the clearest asymmetric setups in today's market. Do your research. Focus on balance sheets. Focus on production growth. Now step back. Two governments, the United States and Mexico, are actively building a silver price floor. The Shanghai Futures Exchange has halted trading. Bank short positions have collapsed to multi-year lows, and the chemical supply chain behind 75% of global silver is being cut at the source. None of this aligned in 1980. Not in 2011. Not in 2025. But it's happening now. Silver at $81 is not a fully priced market, it's a pre-repricing number. Institutional targets sit at $117. Independent models point to $300, $500, even higher. You're not early, but you're early enough, so I'll leave you with this. What's your silver target for 2026? $100, $150, or beyond? Accumulate with conviction. Hold with patience, and understand what you own.